Now that we have an understanding of the financial markets, organizational structure, and the role of finance in some of the finance jobs that are available, I would like to start with some introductory concepts. First thing I want to comment on is accounting versus finance. Accounting is a very important component of what goes into finance. Finance is based on accounting and accounting information. So let's come back and define what accounting is. Accounting is the process of recording and organizing financial information to present a historical picture of what the firm has done. It is historical. And it's a format and method based on what we'll call generally accepted accounting principles. It can include international accounting standards, rules established by the Securities and Exchange Commission. Other tax and regulatory bodies set rules for reporting. Financial statements can be audited. That means there's an opinion expressed on financial reports by an independent auditor. Statements can be unaudited, meaning they are prepared by the company or they're prepared by an accounting firm, and they're either what we'll call compiled or reviewed. Compiled simply means that the accountant has taken financial information and presented it in a financial statement format. A reviewed statement it's not an audit, but it basically says that we've taken the company's information, we've put it in financial format, and we've done a review, and they don't express an opinion, but they make sure they have done a review. And a review is a very limited scope procedure that's applied. You're going to find that in private companies and in smaller companies, compilations and review are much more common. However, once you go to publicly held companies, they are required to have an audit. Now, that audit is only done on an annual basis, so they're company prepared when you get to the quarterly. So the annual is the audited one, quarterly is not. But we don't need to actually get into that right now. So now that that's what accounting is, the question then, what is finance? And I would say you got to start with finance is the interpretation of accounting results. It becomes very future orientated. It's action orientated. We're looking for it to make a decision, use it to be planning. It's taking information and making it into actionable on the point of either management, that they can take certain actions as a result of analytics that we do in finance, or investors. And it's a broad range of concepts and approaches. And I think it's based on a science, but it is also an art. It's less standardized than accounting. And you will see this as we go through the course, is that I may give you a definition. You may look in finance books, or you may look online and get one that's slightly different. They're very similar, they mean different things, but you have to carefully understand what is it that is going on. Now, when we look at finance, there's different points of view. It can be an internal to the company, meaning that there's people within the company who are doing the analysis, okay, and they're used for management purposes. That can include cash flow management, profitability reporting, how is a business unit doing, how is a geographic unit doing. It can be used to determine capital structure. It can be used in pricing decisions. It can be used in the planning process, short and long term. It can be used for capital budget. It can be used for compensation of employees, and it's part of the risk management perspective. So the point of view could be within the company. The company is using this approach, these tools and techniques for these purposes. That's one point of view. The other point of view is an external user. Now, when you look at external users, there's a lot of people who use financial information from companies to make decisions. The first one is a customer. So a customer wants to, if it's a retail customer, it's not as big a deal, but if it's a commercial customer and what this company makes goes into the product, For example, if you're making Boeing aircraft, you are very concerned about the ability of the person that is going to make perhaps the seats or the wings. You want to make sure they're financially sound so they'll be able to continue to make to be able to fulfill their contract to you as a customer. The auto industry has the same issue. They don't want to be caught in a situation where the person who makes the starter of the car is going to go out of business and they're going to be stuck. So they want to really make sure that their suppliers, their customers look at it to make decisions. Okay? Because if they have problems, they may try to take shortcuts. They may not be a reliable source of a supply. Suppliers, if I'm going to sell you as a company materials for you to make something, I want to get paid. Sometimes I may actually extend credit to you and say, here's the materials, pay me in pay me in 30, 60, or 90 days. Before they make that decision, they have to do some analytics. Lenders, credit analysts, do they want to lend you money? They want to get repaid, so they're going to look at your capacity to repay, which is based on your profitability of your firm, your ability to be sustainable. Rating agencies, these are Moody's, Standard & Poor's, Fitch, who rate debt securities. So they're going to look at the company and express an opinion on the quality of the company's debt. So they look at it. We then have investors, institutions, mutual funds, individuals. All investors look at this information and use different tools and techniques. Then there's companies who may like to buy the company. Potential acquirers may apply different financial tools and techniques to the company. Now, keeping going on the external users, a lot of times we hear this word of Wall Street analysts. Analysts are a big thing. But we're going to go in, I just want to give you a little bit more background because this is sort of where my mind is right now. I've actually worked on the internal side as an internal user. I've looked at it from a lender, lending funds to companies. And where my brain is right now and what I'm focusing on is from an equity perspective, financial users can be analysts. And these analysts are those that help Wall Street investors, mutual funds, pension plans, institutions, endowments, and personal investors be able to make investment decisions. The first one we're going to talk about is this sell-side analyst. And what a sell-side is they follow a list of companies, typically in the same industry, and they provide a research report to clients, which include financial estimates, stock price target, and a recommendation as to the stock's performance. Sometimes they sell this information for a fee, and sometimes the fee is lower, and sometimes the fee is very high. So they provide that information. And to do that, they understand the financials of the company, they build models, they speak with customers, suppliers, competitors, and the firm itself. What they bring is they've created an expert network so that there's a deep understanding. And they understand, if we're in the coffee business, they will understand what the impact of cold weather in Brazil is going to be on that company. So they really know the company and what's driving it. What are these key factors, if you will? But it's by creating this network and relationships. And the first one in with sell-side information creates value. Being third or fourth in telling somebody the same thing isn't useful. Okay? So it creates value. Their real objective is to direct clients to their firm's trading desk. So if you get a report from Credit Suisse, you get a report from Goldman or Morgan Stanley, they do the analysis, but they want to drive trading to their desk so they can make money that way. Other people sell information. Sabriant, Morningstar, Cliff Research. You're going to find Cleveland Research. You're going to find a number of research firms who sell information and not related to the trading desk. but a lot of them are trading desks. And it's about providing information. And you got to pay for it. And it's useful information. So those are the sell-side analysts. And that information is sometimes available, and it's not often as easy to get as we might find on the buy side. Now, on the buy side, there's analysts, and what they're doing is they're buy side analysts, and they're internal to a firm. So they could be in a mutual fund, a pension fund. These are people who are actually buying. They're doing the analytics to make an investment decision. Sell side is simply providing information to you. And they tend to follow a sector, a healthcare sector or technology. Again, they do a research report, they do financial estimates, they do stock price targets and recommendations. Okay, but they're more focused on news. They still have this network that they've built. Okay, they have the models, they understand the financials, but they're more news driven than on the ground. And oftentimes they try to sort out what sell-side analysts say. So they may have 4 or 5 reports on a company, and they're trying to analyze what the sell-side analysts are saying. From an analyst on the buy side, it's about being right, okay, in this stock pick. So those are different points of view when we get into the analysis. And the analysis is using the tools and techniques that we have in the world of finance. Where do you begin? Everything begins with the historical financial reports of the company. It's the 10K, which is filed with the SEC, the 10Q, which is the quarterly report filed with the SEC. Then there's the proxy statement, and this is called the DEF 14A. And what this tells us is the compensation of the officers, election of directors, appointment of auditors, and other matters to be brought in front of shareholders. But the biggest information that we can get out of it is who are the officers of the corporation and what is the compensation. If we go to the company's website, they also have conference calls and investor information that is available. So you always want to start with the company's website. If they're publicly held, they'll have a section called Investors, and we'll see that momentarily. And we'll go through it, and we'll be able to see what's there. For purposes of this course, all historical information should come from these sources or documents. Do not use Yahoo Finance, Wall Street Journal Finance, or any CNBC Finance. Please go, I want you to use the 10K, 10Q, the proxy, and investor material, because I want you to do the analytics that are needed. Now, since it starts with the financial reports, I'm going to give you a basic 5-minute review of accounting. Accounting concepts. With all due respect to my colleagues in accounting, accounting is relatively straightforward. You find there's a couple of rules, and these rules or concepts are very important. And every time you look at a financial transaction, you have to put these few things in place. If you've taken accounting courses, I will guarantee you that if you got something wrong, you forgot about one of these rules. The first, the basic, debits equals credits. So if something happened, there's always an offset. Make sure you know what the debit is and the credit is. Very easy. Okay? Straightforward. Accounting follows the business. Okay? If you sell something, that's income, but it follows the business. Thirdly, matching. You want to match expense with revenues. So that means your electric bill that you're paying for the month should be charged against income for the month. If you buy a piece of equipment and it's going to benefit 5 years, you spread that cost out. So basically, it's all about debits equal credits. Always make sure you understand both sides of the equation. Just don't talk about one. So if you've got an inventory, what was the offset? Was it cash or was it accounts payable? You always need to understand both sides. Accounting follows the business. What is the business transaction? What is the business doing relating to its products and services? Matching. That you want to match revenues and expenses. And the other one, and this gets companies in trouble, is accrual versus cash. If you remember with accrual that it's picking up accounts receivable, accounts payable, trying to match revenues and expenses even when you haven't paid them. Cash is when cash comes in and goes out. Understanding these four things is all you need to know in accounting. And you can ask anybody in accounting if that's really the issue. And when you push them, they'll probably agree. So once you got that down, we're going to go to financial statements. Balance sheet, fundamental. It's a point in time. So if a financial statement is dated April 30th, that's a picture of the firm at that point. Management, on the other hand, is every day. So as I'm a manager, it's nice to have that balance sheet, but I need information every day to make decisions. Remembering that's assets, liabilities, and equity. There's current assets, those that come about from the result of the business cycle. More about that next week. Long term, used to produce an output. Okay, so if you buy a machine and it's going to benefit multiple periods, you're not only going to take the expense over that, but it's going to be used to produce your product. Then we have equity, capital, the owner's investment. Move on to the income statement. We have revenues and sales, cost of goods sold, gross profit, which is revenue less cost of goods sold. What's the cost of selling it and running the company? What's the interest expense? Profit before taxes, taxes, and net income. If you don't remember too much of this from accounting, I'd suggest at this point you step back and you take a read through your accounting textbook. Cash flow statement. I think one of the most important things. To me, cash is everything. We can talk about nice things on an accrual basis, but it's only about the cash. And that tells us how cash was generated. Did it come from operations? Did we sell an asset? Did we issue debt? Did we issue securities? And then what did we do with it? It comes from operations, which is the day-to-day business. Investments. We could sell investments, buy and make investments, equipment. Financing. Did we pay down debt? Did we borrow? And then there's always other things, and you just foreign exchange translation. I'm not going to get into a lot of that detail at this point. Then we move on to management discussion and notes to financial statement. These are integral parts of the 10K, and I want you to go through a 10K and see how it comes together. The first part of the 10K is management's discussion of the company, its financial results, and balance sheet position. It also talks about risks the company has. After the financial statements, there are the notes, which explain the financial accounting policies and detailed discussion of what makes up the balance sheet and income categories and what information is needed to understand that. There's a plethora of information both in the management discussion and in the notes. Anything you look at, the answer should be in the 10K. You might need to look because it's rather large. The next thing you want to do is move on to application project 1. Please let me know if you have any questions.